2015 was an incredible year, strong performance across the board, and really this continues a streak, kind of the post-recession streak for the industry as it has emerged from the recession, and growth continues. So, Alex, do you want to talk about some of the headline numbers that we're seeing as we get into 2016 here?
Absolutely, Jay. And as the slide says here, 2015 really was a milestone year. We hit an all-time high in membership. We're providing 28 million members new loans, over 410 billion outstanding loans, and member relationships are reaching a new level. So we want to take a look at some of the detail behind this. And one of the key things we've noticed here is the growth, the continued growth in membership. We are at 104 million members today, and this has been growing ever since, as you can see, the graph has started. But one of the things I think was most interesting was the talk of Bank Transfer Day and how that was going to be the year that everything changed. And yet every year since then, we've managed to actually continue this growth. On the next slide here, we're going to see that those new members brought with them those deposit accounts. We now top $1 trillion in share balances at year end, and this is the highest growth rate since 2009 when there was the flight to safety during the recession. So this is the highest we've seen, and this is both the result of members who are already with the credit union growing their shares, as well as new members coming in and bringing deposits with them. Let's take a look at the lending side. This chart shows the originations this year. So last year the story was all about consumer loans. We'd grown from 193 to 220 billion. This year consumer loans still grew. Consumer in this sense makes up mostly auto, but there's also credit card, student loans, and other things in that bucket. But the real story this year was the rebound in the first mortgage originations. It's up 33% over last year, and it tops the all-time high of 124 billion in 2012, which you don't see on the slide, but that was the largest first originations growth for first mortgages in an entire year period. All the other categories are up as well, so the entire origination volume is up 16% over last year. Now turning to the balance sheet, this shows how many loans are outstanding for credit unions, and we are at almost $800 billion. We've reached the highest average member relationship ever. We are just over 17,000, which is up almost 5% from last year. This is a combination of loan and share balances, excluding the member business loans that we've been talking about. This is really the retail relationships that we have. And this is showing that the depth of relationship that people are bringing to credit unions is also growing.
I mean, just the tremendous numbers in members, shares, loan balances, loan originations, all those. Those are the headline numbers. But we wanted to look a little more closely at the different aspects of this performance and go a little deeper, because I think what you see is, in fact, from a number of angles where credit unions are having momentum. And so let's look a little bit more at that. First, let's start on the deposit side. What you see here is the growth in the deposit portfolio, 2015 versus 2014 for the full year. The red bar is 2015. You see a lot of variation in the growth across accounts, really flat balances in certificates and IRAs. Hasn't been as much a focus of credit unions, although certificates may be coming back a little bit as liquidity tightens for some. But where you really see the growth is in those core accounts. The growth in checking balances, shared wrap balances of over 14%, regular savings up 10%, continuing and accelerating a trend that we saw last year.
And Jay, I think that shared draft number is so important because the transaction account is really the core relationship a member has with their institution. So to see the checking accounts continue to grow is just a phenomenal indicator of future growth in credit unions as well.
Yeah, and we're at about 55% penetration rate, the percentage of members with a checking account. That increases. So as we talked about earlier, membership's growing, but actually checking accounts growing at a faster rate. So you're getting deeper relationships, as you showed earlier, kind of across the board. Now, it's not just the big credit unions. I think another aspect as we think about looking at performance across the different angles, you see here the growth in average share balances over the last year by different credit union asset sizes. And what you see here is actually the smaller to mid-sized credit unions are actually growing at or above the national average, and the larger credit unions are actually growing at a little bit slower rate in terms of average share balances. So again, I think as we say, performance There are the headline numbers, and generally the bigger credit unions do kind of push those forward, but there is success, I think, across the range in developing relationships. Again, that 7% growth rate in the share portfolio overall was outpaced by the 10.6% growth in the loan portfolio. So you see the loan-to-share ratio coming up to over 77% at the end of the year. We were a little over 80% at the end of 2008. Now, when we look at what it means for the balance sheet, this looks at the growth on the balance sheet of the different components of the loan portfolio. You see auto lending taking the lead here. Both balances in new and used autos slowed versus 2014. Used auto about the same. Overall, though, the loan portfolio on the auto side continued to grow about 14%, so still very strong growth. A lot of that is led by indirect. About almost 3/4 of the growth in the auto portfolio was due to indirect loans. If you look at total revenue, it's up almost 7% over a year ago, and this is an environment where rates have been flat. So it really reflects members turning to their credit unions for the value that they're providing. The bulk of the growth in revenue comes from interest income, comes from those new loans on the book, as we talked about, at record levels. ROA is down slightly, but if you joined us for our third quarter, we saw that ROA was about equal year over year. So this December dip, I think, Alex, as we saw, is due primarily to a lot of patronage and bonus dividends.
Exactly, because credit unions can manage their bottom line. They don't have to answer to shareholders. They're answering to their member owners and returning value at the end of the year if they don't need it to enhance their capital ratio, which is what we're seeing, goes back in the form of patronage dividends.
That's right. And I think, when you look at the capital numbers, capital at a new record high, another milestone there, $138 billion in total capital. $5 billion of that is in the allowance account, which is over about 114% in terms of the coverage ratio of allowance for loan losses to delinquent loans. So, they don't really need that ROA either. They would rather give it back to members.